Hello, welcome to Disciplined Investor Affirmations by Value and Momentum Portfolio. Investing rewards the prepared and the patient. The screens will try to rush you. The crowd will try to scare you. And the only edge that survives all of it is a steady, disciplined mind. So we're going to slow down for a moment. What follows is a set of affirmations. Short, first-person reminders of how a great investor thinks. Take a breath. Settle in. Let's begin. Part 1. The process is my anchor. I trust my process more than I trust any single outcome. I judge my decisions by the quality of my reasoning, not by the color of the screen. I follow my checklist before I follow my emotions. I let my edge come from preparation, not from prediction. I do the work that others skip, and I do it again tomorrow. I separate a good decision from a good result, and I honor the decision. I write down my thesis so that my future self can hold me accountable. I welcome being wrong early because it is far cheaper than being wrong late. I measure myself by the discipline I keep, not by the day I'm having. I prepare in the quiet so that I can act in the noise. I return to my framework whenever the market tries to rush me. I build habits that make good decisions feel ordinary. Part 2. I own businesses, not tickers. I buy a share as a fractional stake in a living business, not a symbol on a screen. I ask what I would pay for the whole company before I ever look at the quote. I think like a private owner who cannot sell for 10 years. I read the annual report before I read the price chart. I judge management by how wisely they allocate every dollar of capital. I want owners and operators whose incentives are aligned with mine. I study the business model until I can explain how it earns a single dollar. I value the franchise, not the headline, and the engine, not the noise. I treat the stock price as the market's opinion, not the company's worth. I would rather understand one business deeply than skim 100 lightly. I look for a company I would be proud to own straight through a recession. I remember that behind every ticker is a team, a product, and a customer. Part 3. I speak the language of cash flow. I follow the cash, because cash is the truth that accruals can disguise. I separate operating cash flow from the stories told around it. I subtract maintenance capital expenditure to find true owner earnings. I tell growth capex that builds the future from maintenance capex that defends the present. I watch free cash flow per share because it is what eventually reaches me. I study the cash conversion cycle to see how quickly sales become cash. I read changes in working capital as a signal of discipline or of strain. I grow wary whenever earnings rise while cash flow quietly falls. I respect a business that funds its own growth from internal cash. I prize free cash flow conversion above 90 cents on the dollar. I trace where the cash goes: reinvestment, buybacks, dividends, or debt. I trust a clean cash flow statement more than a polished press release. Part 4. I read the numbers clearly. I value a business by the cash it can return to me, discounted patiently back to today. I build my discounted cash flow on assumptions I can defend out loud. I run the reverse DCF to hear what the price is already promising. I ask whether a business can truly keep the promise its valuation has made. I treat the gap between implied growth and proven growth as my signal, not my fear. I read a price-to-earnings ratio as a question, never as an answer. I use enterprise value to EBITDA to compare companies on the capital they truly employ. I let my discount rate reflect honest risk, not wishful thinking. I respect a terminal value only when the business has earned the right to endure. I keep my models simple enough to understand and humble enough to revise. I let the numbers speak first, and I add my judgment second. I remember that a forecast is a hypothesis, not a fact. I would rather be approximately right than precisely wrong. I let valuation set my entry, and I let the business earn my patience. Part 5. I decompose returns. I break return on equity into margin, turnover, and leverage before I admire it. I prefer returns built on margin and efficiency, not on borrowed money. I calculate return on invested capital as net operating profit over invested capital. I care most about the return on each new dollar the business reinvests. I want incremental returns on capital that comfortably exceed its cost. I measure the spread of ROIC over the cost of capital because that spread is value created. I know that a wide spread sustained for years is the engine of compounding. I treat the weighted cost of capital as the hurdle every project must clear. I let asset turnover tell me how hard the balance sheet is working. I watch gross and operating margins for the quiet signature of pricing power. I reward the company that grows its invested capital only when the returns justify it. I remember that quality is simply a high return on capital that endures. Part 6. I judge quality. I respect return on invested capital above reported earnings because returns on capital tell me who compounds. I want the spread between ROIC and the cost of capital to be wide, durable, and earned. I check free cash flow conversion before I believe a single headline number. I trust cash flow more than I trust a story about cash flow. I look for stable gross margins because pricing power is the quiet proof of a moat. I demand a runway for reinvestment because compounding needs somewhere to go. I remember that growth equals the reinvestment rate times the return on capital. I let that simple identity discipline my dreams. I prize the business that can grow without begging the market for money. I favor durability over excitement and consistency over spectacle. I want a moat I can describe, not merely a momentum I can feel. I treat quality as a gate, and I let only the worthy through. I would rather own a fortress at a fair price than a fad at any price. I look past the quarter to the decade. Part 7. I price what I buy. I never confuse a great company with a great investment until I have checked the price. I anchor my discounted cash flow to free cash flow I can actually defend. I run the reverse DCF to back out the growth the current price demands. I compare that implied growth to the growth the business can truly deliver. I read the earnings yield against the yield on a safe government bond. I want an equity risk premium that pays me for the uncertainty I accept. I use enterprise value to operating income to price the whole business at once. I check enterprise value to free cash flow before I trust any simple multiple. I treat the price-to-earnings ratio as useful shorthand, never as gospel. I weigh a price-to-earnings-to-growth ratio against durable growth, not a hopeful forecast. I stress-test my valuation across a bear case, a base case, and a bull case. I require my upside to outweigh my downside before I commit a single dollar. Part 8. I demand a margin of safety. I buy with a margin of safety, so the future does not have to be perfect for me to be paid. I buy below my estimate of value, so I am paid even when I'm wrong. I read debt to equity as a measure of fragility, and I refuse to confuse leverage with skill. I measure net debt against EBITDA before I let myself admire the growth. I respect a strong balance sheet as the freedom to act when others cannot. I check interest coverage to know whether the business can endure a hard year. I let price be my friend and never my master. I read the current ratio as a simple measure of breathing room. I pay for value, and I refuse to pay for hype. I respect a fortress balance sheet as optionality the market gives me for free. I wait for the discount the market eventually offers to the patient. I assume the future will surprise me, and I price that surprise in advance. I size my conviction to the evidence and never bend the evidence to my conviction. I size my margin of safety to the fragility of my own assumptions. I protect my downside first, and I let the upside take care of itself. I would rather surrender some upside than risk a permanent loss of capital. I would rather wait in cash than reach for a price I cannot justify. I avoid the company that survives only if everything goes exactly right. I let a wide margin of safety forgive the mistakes I cannot foresee. I seek asymmetry, where my downside is bounded and my upside stays open. I never confuse a falling price with a bargain until the numbers agree. I let a low entry price do the work that optimism never can. I keep my standards high when the market makes it easy to lower them. I never let leverage inside a business become a substitute for its quality. Part 9. I master my emotions. I observe my fear without obeying it. I notice greed in myself, and I name it before it trades for me. I breathe before I click, and I think before I size. I stay calm in the drawdowns I planned for. I stay skeptical in the rallies I did not. I let red days test my thesis, never my self-worth. I refuse to let a green screen flatter me or a red screen shame me. I feel my emotions fully, and I let my process decide. I am the calm at the center of my own decisions. I do not trade to relieve my discomfort. I let patience be the muscle I strengthen every day. I meet volatility with stillness and uncertainty with preparation. I am steady when the market is not. I return to my breath whenever the noise grows loud. Part 10. I govern my psychology. I notice when I am anchored to the price I paid, and I gently let it go. I weigh the base rate before I surrender to a vivid story. I treat recent events as data, never as destiny. I feel a loss more sharply than a gain, and I refuse to let that distort me. I seek the evidence that would prove me wrong, not only the evidence that soothes me. I separate the quality of my decision from the noise of its outcome. I hold my opinions loosely and my principles firmly. I distrust the confidence that arrives too easily. I slow down whenever I feel certain and excited at the very same time. I name my biases out loud, so they can never trade in secret. I let my checklist catch the errors my emotions would happily miss. I remember that the hardest opponent I face is my own mind. Part 11. I silence the noise. I let the market be loud while I stay quiet. I do not chase a move I did not understand on the way up. I am willing to miss a winner in order to avoid owning a story. I treat the fear of missing out as data about the crowd, not as instruction for me. I turn down the noise so that I can hear the numbers. I let the headlines pass through me without taking hold. I measure my life against my own plan, not against another's gains. I do not need to own everything to be at peace. I let other people's urgency stay with other people. I find freedom in the trades I choose not to make. I trust that missing one opportunity does not close the market. I let the crowd run, and I keep my own pace. Part 12. I resist the crowd. I let the fear of missing out wash over me without ever acting on it. I grow most cautious when a story needs no price to justify it. I remember that extreme growth tends to revert toward the average. I lean against the consensus only when the evidence is clearly on my side. I am content to be early, lonely, and eventually right. I refuse to buy a thing merely because it has already gone up. I see that price can shape sentiment, and sentiment can shape price. I do not let a rising tape rewrite my estimate of value. I treat euphoria as a warning, and despair as an invitation. I let the crowd supply the volatility that funds my patience. I measure a company by its cash flows, not by its momentum. I keep my own counsel precisely when the headlines grow loudest. Part 13. I manage risk and position size. I size each position to my conviction and to what I can afford to lose. I let my best ideas be my largest, and I keep my doubts small. I never let a single position threaten my ability to stay in the game. I watch for hidden correlation, so I'm not making one bet 10 times over. I diversify enough to survive surprise and concentrate enough to matter. I plan my response to a drawdown long before the drawdown arrives. I rebalance toward my discipline, never toward my fear. I think in expected value across many decisions, not in a single outcome. I would rather bet modestly and stay solvent than bet boldly and break. I keep dry powder so I can act when others are forced to sell. I let risk management protect the compounding that time provides. I respect that survival is the first condition of every great return. Part 14. I hold with conviction. I hold my best ideas long enough for compounding to do its work. I let time, not timing, build my returns. I anchor my largest positions to my deepest conviction. I begin as a starter and earn my way to core and to anchor weight. I let thesis uncertainty decide my position size. I add when price and fundamentals agree, and I wait when they argue. I let a thesis play out on the company's clock, not on the market's mood. I would rather own a few businesses I truly understand than many I merely follow. I let cash be a position when nothing meets my standard. I act with conviction once, and I revisit it with humility often. I hold through the discomfort that long-term ownership requires. I let my winners run while the thesis remains intact. I cut what is broken and I keep what is working. I am the patient owner the great businesses deserve. Part 15. I stay accountable. I own my mistakes openly, and I learn from them quickly. I write my thesis and my reasons before I buy, so I can be honest with myself later. I keep an honest record of every call I make. I conduct a pre-mortem and imagine clearly how this investment could fail. I let my track record speak before I do. I update my view as the facts change, without clinging to my former self. I take responsibility for my outcomes, and I share the credit for my wins. I weigh new evidence in proportion to how much it truly should move me. I never hide a loss from myself. I keep a journal of my decisions, not merely a record of my results. I invest with integrity, and I sleep well because of it. I admit a mistake quickly because pride is the most expensive position of all. I refuse shortcuts that I would be ashamed to explain. I work to separate luck from skill when I judge my own track record. I tell the truth about what I know and what I do not. I ask what I would have to believe for the opposite to be true. I let my conviction be earned, never borrowed. I review my losers far more carefully than my winners. I respect the capital entrusted to me as if it were my own. I let accountability sharpen my judgment for the very next decision. I stand behind my reasoning even when the result disappoints. I tell myself the truth, especially when the truth is uncomfortable. I let accountability make me sharper, not smaller. I treat every market cycle as a lesson I am being offered. Part 16, I let compounding work. I compound my judgment as patiently as I compound my capital. I let time in the market do what timing the market never can. I let small, sound decisions accumulate into great results. I keep my turnover low because every trade leaks friction and tax. I trust the quiet arithmetic of patience. I let great businesses compound while I do nothing but wait. I show up for the process on the days it feels invisible. I protect my returns from the quiet drag of fees and impatience. I let consistency become my edge. I measure my success in decades, not in quarters. I grow a little wiser with every cycle I survive. I trust that disciplined patience is the rarest edge of all. I am building something that time will reward. I own businesses. I price them with care. I hold them with conviction. I am a disciplined investor. I am a patient owner of great businesses. I master my mind, I respect the numbers, and I let time do its work. I am a calm, disciplined, and patient investor. I trust my process. I respect the numbers. I master my mind. Thank you for listening, Value and Momentum Portfolio. Join the Value and Momentum Portfolio. Institutional-grade equity research from a former Lazard and Rothschild and co-investment banker. I'm Dennis D., and I bring sell-side rigor to in-depth fundamental coverage of U.S. and international mid-caps, paired with high-conviction momentum setups. Each week, my proprietary screens deliver a decisive data edge. Sell-side upgrades, insider and institutional fund flows, aggressive options activity, and second derivative growth analysis by sector. Subscribe to start your analysis now.